At this point, we've mastered how to get a long-lived asset on the balance sheet, debit an asset, credit cash or notes payable, and figure out what number to record when we buy it or build it. You'll recall that this process is called capitalization, and it's essentially a deferred expense. Now we turn to the next question. Once we've recorded the asset, how do we account for it over the years that we actually use it? That's what this chapter is about, utilization. And the single idea underneath all of it is something called cost allocation. Here's the most important thing I want you to take away from this entire lesson, and I want to say it before we do anything else. Depreciation, depletion, and amortization are not three different topics, and they also don't have anything to do with the value of the asset. They are three names for the exact same idea, spreading the cost of a long-lived asset over the periods that benefit from using it. That's it. If you understand allocation, you already understand all three of these. The only thing that changes is the type of asset. When we allocate the cost of a tangible asset, a building, a truck, a piece of machinery, something you can touch, we call it depreciation. When we allocate the cost of a natural resource, an oil reserve, a coal mine, a tract of timber, we call it depletion. And when we allocate the cost of an intangible asset, like a patent, a copyright, or a franchise, we call it amortization. Same concept, the name just changes depending on what we're allocating, and the names are often used interchangeably. So why do we spread the cost out at all, instead of just expensing the whole thing the year that we buy it? Think back to the matching principle. When a company buys a delivery truck for $50,000, that truck's going to help us generate revenue for, say, 5 years. If we expensed the entire $50,000 in year one, we'd slam all of that cost into a single year and then show 4 more years of revenue with no truck cost at all. That doesn't really reflect reality, and it's not useful for assessing a company's performance. The truck helps us earn revenue in every one of those 5 years. So we need to allocate a portion of its cost to each of those years. Allocation is just the matching principle applied to long-lived assets. Now, I mentioned that allocation doesn't have anything to do with a decline in value, and this is possibly the single biggest misconception that students have about depreciation. Depreciation is not an attempt to track the market value of your asset. It does not tell you what your truck is worth today. Think about a car you own or want to own. You paid some amount for it, that's your cost, and you expect to drive it for some number of years, that's its service life or useful life, and you figure you'll get some trade-in value at the end. That's what we call the residual value. Now, the amount a car actually loses in market value is wildly uneven. We've all heard the old adage that a new car depreciates the second you drive it off the lot. And there's certainly some truth to that. A new car can lose 20% the moment you drive it off the lot. But in accounting, that's not what we're talking about when we say depreciate. Maybe the asset's worth less, maybe it's not. We are not accounting for the asset's value over time. We are accounting for the initial transaction, purchasing an asset that we intend to use to make money over the long term. So accounting depreciation takes the total cost of the car, including whatever costs were necessary to get the asset ready for its intended use, and spreads it across the 3 years that you drive it in a simple, systematic way. The journal entry is to debit depreciation expense and credit accumulated depreciation. Notice that we don't credit the asset itself. Instead, we use this contra asset account called accumulated depreciation. This is because the asset still exists. We don't want to eliminate it from our balance sheet, just reduce its book value. And the book value equals the asset account less whatever balance is in the accumulated depreciation or contra asset account. The contra asset account represents the credit side of that account. So here's the consequence and why it matters. At any given moment, the book value of an asset, its cost, minus its accumulated depreciation, is almost never equal to its fair value. That's not a flaw in the system. Depreciation was never trying to measure fair value in the first place. It's allocating cost. Hold on to that idea because it's exactly why we may need to recognize gains or losses when we sell assets down the road. Every allocation calculation, whether we call it depreciation, depletion, or amortization, needs the same 3 ingredients. First, the asset's cost, the capitalized amount we worked so hard to determine. Second, an estimate of the service life, or how long we expect to use the asset, measured in years, or sometimes even in units of output. And third, an estimate of its residual value, also called salvage value, what we expect the asset to be worth at the very end of its useful life. From those 3, we get one number that drives everything, and that's the depreciable base, or cost minus residual value. It's the total amount that we're going to allocate to expense over the asset's life. No more, no less. Notice that the residual value is the piece we don't allocate because we expect to get it back at the end. We don't need to recognize expense for it. And here's the elegant part. There are several methods we can use to allocate that depreciable base over time. Straight line, accelerated methods, or activity-based methods. And we'll cover all three of those. But every single one of them allocates the exact same total over the life of the asset. The method only changes the timing of that recognition. How much cost lands in each year. It never changes the total. So whichever method you choose, by the time the asset's fully depreciated, you've expensed the same depreciable base. So to summarize before we get into the mechanics, depreciation, depletion, and amortization are one concept, allocating an asset's cost over the periods that it benefits, under three names, for tangible assets, natural resources, and intangibles. We allocate to satisfy the matching principle, not to track market value. Book value is cost minus accumulated allocation, and it usually does not equal fair value. Every calculation needs cost, service life, and residual value, which together give us the depreciable base. And whichever method we choose changes only the timing of the expense, never the total. In the next lecture, we're going to put it all together with the actual depreciation methods.